The broadcast is now starting. All attendees are in listen-only mode.
Hi there, traders. Sorry for that small delay. We had a scheduling conflict, and then actually continued with the old webinar rather than starting with this webinar. So it was a little bit of a confusion with regard to the correct webinar. But now we're in the right room with you and taking a look at Fibonacci levels. All right, that's the target, the topic. Sorry, the topic of this webinar, using Fibonacci expansions, retracements, and targets for trading, of course, the financial markets. So let me check if there are any questions. I hope that the sound and the how do you call it, the screen is working as it should be. Let me know if that's fine. Otherwise, with no longer ado, we can finally continue. All right. Thanks, Peter. Good. And sorry for that confusion there. We went actually back to the old webinar by accident. So, but now we're here. So, first of all, this webinar is shown to a global audience, but may not be suitable for everyone. Please visit admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity to find out if it is suitable for you. Second of all, please note that trading for exchange and global financial markets is considered high risk. Please seek the advice of an independent financial advisor for more information on that. This webinar is for informational and educational purposes only. By continuing watching this webinar, you agree with this disclaimer and you are aware of the risk involved when trading. Alrighty, so thank you for your attention on that. Once again, webinar is hosted by Admiral Markets, and you can check out more info about Admiral Markets and how to trade, how to find analysis, webinars, education, but of course also what instruments you can trade and how you can set up an account with at admiralmarkets.com. This webinar specifically is focusing obviously on Fibonacci. I'm going to take a look at swings, Fibonacci ratios, and targets. I do think that, let me double check, but as far as I remember, it is a two-part series, actually. Yes, it is. It's a two-part webinar series, which has the second part on Thursday. So that's something where we'll dive into more details as well. We're going to take a look at swings, Fibonacci ratios, Fib targets, and Fib sequences. So basically, swings is very important because we need to know where to place the Fib. We also need to know when not to place the Fib. So it's very important when to use the Fibonacci level because, as you probably know, the Fib tool is something we traders and analysts have to do ourselves. We have to really actually deploy or add the Fib tool to the charts. It's not something that can be automated or automatically done. Maybe, who knows? There is some tool or indicator that does that automatically. I don't know about it, but you never know. Today's technology is very advanced, so maybe some of you know about that, and that could be pretty handy, I guess. But obviously, check which swings that system, that automated system, does use, if it exists. I don't know. For the moment, though, I still am an old-fashioned trader that puts the Fib on the swings myself, so it's very important to know which swings to use. It is really a core aspect of Fib trading and using Fibs. We're going to dive into, once we know how to use the Fibs, in what the targets are, what ratios, and also sequence levels. Generally speaking, price tends to respect Fibs levels, retracement levels, target levels, if we place the Fib on the proper spot, but it is not a guarantee. Everything is a probability, so it doesn't mean that always price responds to the levels. And sometimes it also depends on which time frame you look at. As you can see here on the example to the right, price respected the 61.8 Fib and reversed away from it, or at least it bounced for a decent move down. Maybe not a reversal yet, because a reversal would indicate, a major fall, but at least a bounce. Whereas the other Fibs, price didn't gain as much respect. The 23.6 Fib, price just broke through it right away. The 38.2 Fib, price kind of went sideways. And the 50 fib price broke through it. All right. So from this point of view, and I know that some might not consider 50 fib a fib actually, right? But this is a debate that I don't think is that valuable. I think that the 50 fib level is a useful level, and whether it's a fib or not, it's just handy to add, because why draw separate levels for fibs and non-fib levels if you can just neatly add it in one tool? So it's a debate that some traders have, but from a practical point of view, I don't think it's too relevant because the market does respect the 50 fib. So why not use it? I think, right? Why not just think practically? But this is my vision, my opinion. And if someone has other opinion, that's fine too. Of course, it's really up to everyone. Uh, but I do use it. The other fib levels, 78 and 88.6 fib, are technically also not fibs, but they are derived from fib levels. The core fib levels are 23.6, 38, and the 61.8 fib. But I do have all six, as you can see, because I like fibs and I have seen their practical usage from my experience. So up to you now to decide. Others have used 76.4. I think it's somehow derived from 23.6 in some way, but I don't use that. The 78.6 fib is the square root, by the way, of 61.8, and 88.6 fib is the square root of 78.6, if you want to know the math behind it. But anyways, back to which fibs get respected or not. So, but the thing is, even if it doesn't seem like price respected it on this time frame, if you zoom into lower time frames, you could see on this fib, the 38.2 fib, right? You might see a reaction there on a five. Say this is a 4-hour chart. On a 50-minute chart, price might stop there. So it depends also on what time frames you're looking at. If you are trading the breakout above the 23.6 fib counter trend, and you're aiming for the 38.2 fib, let's say there's a trend line here, right? You took that breakout, you took the break, you waited for the break above the 23.6 fib, you took the long, counter trend long. What would be your target? Well, a good target could be the next fib, or maybe the fib after that, depends on your analysis. So if you're aiming for the 50 fib with your long setup, it might be good, but if you're trading a 50-minute chart, maybe it's better to aim for the 38.2 fib, because eventually price did reach further fibs. But on a 50-minute chart, there could be a lot of volatility around the 38.2 fib, as you can see. There were a couple of 4-hour candles. That might look easy now in retrospect, but how many traders have patience to hang in 3-4-hour candles on a 50-minute chart? That 4-hour candle has 16 15-minute charts, 15-minute candles. So that's 48 candles of 15 minutes that go sideways. Do you really have that patience? Maybe yes, but many don't. So, it really depends on what time frame you're looking at. If you're trading on a 15-minute chart, then probably this is the zone you want to think about. Unless you have a lot of patience and you know that about yourself and you're able to survive this kind of consolidation at the 38.2 fib, then okay. Well, anyhow, not too important. My point is that most fibs do, if placed well, do get respected. It depends on what time frames you're looking at. So on this 4-hour chart, we had 2 out of 4 fibs more or less respected. On lower time frames, they all got respected probably. On higher time frames, it probably looks like only 1 out of 4 time frames got respected. My rule of thumb is that typically 2 out of 3 fibs get respected. So it's not a guarantee, but it's a pretty good chance. Typically, of course, the higher you go, I mean, there's a decent chance that the 23.6 fib will get broken. It depends on the wave patterns as well. Fibs and waves go pretty neatly together. But yeah, I would say, this is a rule of thumb. Please don't hold me to it. Really, really, it's really a very loose idea of what I think is the chance. But I would say 1 out of 4 maybe price respects this level. Maybe it's 1 out of 5. 38.2 fib. maybe 1 out of 5, 2, 50 fib, maybe 2 out of 5. That's too much already. Maybe 1.5 out of 5, 61.8 fib, 1 out of 5, 1.5 out of 5, and then, no, that's already 5 out of 5. So that doesn't make sense. So maybe 15%, 20%, 25, 25. Let's see, that's 35, 60, 85. Let's make it 50. Let's make it 10, 15, and 25 for the deep fibs. I'm talking now about the actual reversal spot for a fib. So obviously, 3 out of 4 times, price uses one of these fibs, and then 1 out of 4, the deeper ones, on average. It also depends on the wave patterns, really. This is just, maybe I shouldn't even tell you these numbers. It's maybe just way too common, because it really depends on situation to situation, because it depends on the waves where price is. But just to give you an idea, that obviously, if you wait for a deep fib, that's the point, basically. That price might not get there because it could turn at a lower fib. So what I do often is I look at candlestick reactions and I do other analysis to see where is confluence. What are the patterns saying? Where would be the most likely turning spot? Which fib would be the most likely level that would be used? All right, shallow fib, you have a higher chance that you will catch the trade, but you have a worse reward to risk ratio. Deeper fib, you got a better reward to risk ratio, but you might miss the trade. So that's why extra analysis is good. But before we get into that, I'm diving a little bit too far. Let's talk about what is a good swing. That's more important. And this is a little bit of background info. If you're really new to Fibs, very, very new to Fibs, please stay and join us still for this webinar. But on top of that, it might be better for you to look at other Fib webinars first that we have had. You can check out Admiral Markets YouTube channel for that. And we've had beginner webinars as well. I don't consider this a beginner webinar, just for your info. So if you feel a little bit lost, and because you maybe never heard of Fibs, or you just heard of Fibs, or you just tried it out, then I'm not going to dive into how the Fib ratios are being. It's not too complicated math, but I'm not going to dive into all of that. Maybe Nenad will. I'm not 100% sure about that, but I'm not for the moment. So if Nenad doesn't, be aware that you can always look at other webinars. All right. So Fibs. Wait, I have one question from ZT actually. Let me address that. Is there any guarantee that if price hits the 50 fib, then it will go to the 61.8 fib next? Means we can use them as target if one fib level is surpassed. Yes, in my opinion, often yes. So if there is good enough space between the fib levels, if you put a fib on a 1 minute chart, and price breaks through the 50 fib, but the next fib is like 2 pips away. Obviously, I think ZT, or I've seen you around in webinars more regularly, so you know that the space is too small. But if you're looking at a decent space, and then you zoom in on a lower time frame to capitalize on that space, yes, should be fine. You can use them as targets, and you can use them as break spots or bounce spots. So fibs in general, we can use them as confluence. If we use multiple fibs on our chart, we can find confluence, and we can find targets and retracements at the same level. We can use them obviously we can use targets and retracements, fibs, and we can use, so as a retrace, basically we'll be waiting for price to dip. So price is in uptrend, and we wait for a bearish dip within that uptrend. Where would that dip stop? We use a fib, and we use the Fibonacci retracement levels. But then once price continues, right, where could price go? We use Fibonacci targets or sequence levels, which is something I will probably be talking about next webinar on Thursday, this week Thursday, 2 days from now. So those swings, so important, right? That is subjective, but there are some things we can make or use, I should say, to make it better. First of all, I'm not sure. Okay, hang on. Let me change the sequence of slides maybe a little bit because hang on. Sorry about that. Maybe first of all, important to note that the the fibs work best when the chart has a trend and momentum. If there's no trending chart and there's a correction, best is to avoid using a fib for that chart or zoom out one time frame and take a look at what's going on. So for instance, if we would be on this is a 4 hour chart. If we're on a 1 hour chart and all we see is this, for instance, right? This part. Well, would it make sense to use a fib or even only like this part, right? No, because price is ranging. We don't know what the context is. Do we put the fib, bearishly or bullishly? Who knows? We zoom out to one time frame and we get context. We got this swing high, so it's good momentum. So yes, we can use that, put the fib from here to here to look for the retracement for continuation of the downtrend. We got context. So we can use fibs like that. Whereas if we zoom in and only see this, we would be confused and probably use the fib. There's a 50-50 chance we would use the fib in the wrong way. So that's good. Zooming out if it's a range. Or zooming in. If we zoom in and we only see we see that the momentum is here, and we zoom out and we see momentum is here, then yes, putting a fib maybe from here to here, it's a little bit riskier than putting it from here to here because of the fact that the price might retrace deeper. But basically, that could be another way of doing that, of course. And down it goes. For instance, this part might be here we see momentum, we see correction, or we can wait for the breakout. That could also be another way of trading fibs. You don't have to trade the fibs necessarily. They could be only used as analysis, and we could trade breakouts towards those fib targets too. That's very important. I'm talking about momentum. So here, obviously, there are a lot of candles. There are way more than 15. So what I'm saying is that that's a good swing. If there are very few candles in that swing, then it's a little bit riskier. Like this here, only a few to the downside. Riskier. Not so established. All right. All right, moving on. Talking about those swings, a lot of good stuff we can use to determine better swing points. Fractals, moving averages, oscillators, waves, patterns, sometimes line charts if candles are not that clear, waiting for price to hit the fib targets before moving a fib. So let's take it step by step here before I hand it over to Nennet, and he's going to share his valuable 2 cents on the fibs. So let's start with the last one, fib targets. So we see a we see a fib here from here to here, right? And price retracing to the 38.2 fib. But if we then start adding another fib somewhere in here, we might be adding a fib too early because price has not really moved away from its what traders call the AB boundary. It has nothing to do with waves. It's just using letters. That's all. To say that this is top and bottom for a bearish fib or bottom and top for a bullish fib. You want to see preferably price move away to kind of the targets to a new area before using a new fib, because otherwise we would just be fibbing in the same spot and we're just taking risk, most likely in a zone where it's the same spot. So it's better just to use the same fib. Once price reaches a target, maybe this target, yeah, we can think about new fibs. When we put a fib from here to here, and we see price hitting these targets, we might think about this fib. A typical good rule of thumb is to wait for the minus 61.8 fib to get hit. I mean, you can think about the minus 272 target, but it's a bit shallow. I like the deeper fib target more. It's a little bit sturdier. So, sorry, that's one thing to think about. So you don't want to move those fibs too early. So waiting for fib targets to get hit. Number 6, waves. So yes, depending on whether you think that this is a wave 1, 2, for instance here, and another wave 1, 2, and maybe this is a wave 3, you will put the fib differently. Or you would expect different fibs too. So wave 2s typically are deep retracements. 61.8, 78.6, 88.6 fib. When wave 3 starts, then you're expecting shallow retracements like 23 and 38.2 fib. So that helps. That's important. If you are seeing an ABC correction, you would expect price to respect 38, 50, 61.8 fib. If you're expecting a flat correction, then you expect price actually to respect the tops and bottoms rather than any fib in between. All right, with a wave 1, you expect price not to go too high to the targets. With wave 3, you expect price to really accelerate to big Fibonacci targets, like in this case. Right, look at that fall. Wave 5, you expect price to go to shallower Fibonacci targets, like the minus 272 target. All right, so those are it's a quick guideline here of the most used fibs in connection with waves. Time factor. So, for instance, here we have a top, and here we have a bottom, and there are a lot of candles after the top and bottom that are formed after that. So there's substantial, number of candles that have arrived or have appeared after that high and low. That is also indicating more like mature maybe, or more kind of used levels, right? If it's only short, like here, it shows that the swing is still continuing. So it doesn't necessarily mean that putting a fib from here to here is a bad idea. It probably did respect the 38.2 fib and continued. It just means that this swing is maybe not necessarily finished. This could still be more like one swing. So this was a smaller fib rather than maybe the main fib. The oscillator will tell us about the direction, right? If we put a fib from here to here, because we think that this is going to be retracement for upside, we would be in for a little bit of an ugly surprise, and yeah, that trade probably would have ended up for a loss, right? Because price moved down and it invalidated the fib by breaking the origin, which is here. That's always the invalidation spot. Just like waves, you have an invalidation spot, which is the starting part of the fib. The confirmation level could be a reaction to the fib, or a break, or price reaching a certain target, etc. So the oscillator will help in the sense that when you have, for instance, here price turning bearish, you might be already a little bit worried about on guard that maybe price is continuing lower rather than this being a retracement, specifically if it breaks through these support levels and the moving averages, for instance. So that's something to be aware of. It also depends on the context of the higher time frames, of course. Maybe this was a retracement within a bigger downtrend, for instance. And there was an ABC correction here. All right, so yeah, you want to, when placing a swing, you want to avoid placing a fib on the swings that are counter trend. This is something you can never do always perfectly. We're going to bump into mistakes, or not mistakes necessarily, but mistakes and or analysis that just didn't work out. That's just unavoidable. But of course, we want to get as good as we can. Pre-fact, that includes learning how to use the fibs and practicing and gaining experience in that. And if things go well, you will start maybe using the fibs. And if you determine that it's somehow not your thing, not your most favorite tool, you can always use other tools. That's fine too, of course. But I definitely at least recommend trying it because I think there's a decent group of traders that use fibs. I think majority of traders do use fibs. So yeah, it's definitely worth trying. Don't give up too soon either because there's always that learning curve at the beginning. So oscillator will help. Also if you look at the tops, for instance, here, there's not very strong convergence, a little bit, but not very strong. So, divergence, of course, would indicate the end of a trend too. You want to be careful then in that case with that, for instance. So using the oscillator for divergence patterns, reversal patterns, continuation patterns is good. Continuation patterns, for instance, like this. Oscillator is going back, retracing, then dips down again like that. That's indicating continuation potential. Moving averages, bearishly aligned here. Continuation, for instance, right? So that's good to have. Sometimes it's not to say we cannot have any counter trend trades against the moving average. Look at this. This was also against the moving average at the time. So, but you want to have divergence at least when that happens. If you don't, then typically it will continue with the trend, with the moving averages. Fractals, make it easier to spot tops and bottoms. And the line charts like this, for instance, right, would help you sometimes indicate kind of the swings a little bit easier maybe than if you're not sure about the swing, looking at the line chart very quickly, look at the line chart, see what's going on. Maybe you see the patterns, the swings a little bit easier sometimes, right? You can see that this is kind of a pattern, and then we had a breakout, correction, continuation, but then we had a sideways move like that. So you can sometimes see it easier, then you can switch back to candles if you like to see price action and reactions more clearly. So that's my part for today. I'll continue, of course, 2 days from now, but let me now pass it over to Nenet, and he'll continue talking about Fibs as well. Hi, Nenet.
Hi, Chris. Lovely introduction. Yeah, I will show how to use basic functions of Fibs and extensions on the MT5 because I've received a lot of questions how to add these levels and how to use Fibs and extensions on the MT5. So this is two-part webinar series. We will start with basics, and next session we will actually expand what are the most popular Fib extensions and why. So now you need to follow me carefully on this. I know that a lot of you still are struggling to actually get these levels. So I will zoom in my chart. Have in mind, this is the MT5. I suggest you also to try to get familiar with the MT5 because definitely MT meta quotes will expand its support to MT5, and there will be less and less support for the MT4. So how you actually add these levels? First of all, guys, you need to add Fibonacci indicator. Okay, so you probably have already seen our webinars in regards to adding Fibonacci extensions, but it's not bad that we can actually remind you again. So in order to add Fibonacci here on the MT5, you need to go to Insert, Objects, Fibonacci, and then Fibonacci retracement. So you always start making your Fibonacci retracement from the left to the right. Okay. In uptrend, you make it from the bottom to the top. So it's always like that, guys. Don't forget. Why? Because you actually take the past plus present gives you the future outcome. It's the logic of Fibonacci. Past plus present will give you the future outcome. Okay, so past plus present will give you something in the future. It's always good to know that Fibonacci's are, these retracements are heavily used in the world of financial trading. So because of that, most of the time they will be very, very accurate. Now, if you know, you need to differentiate between important, less important, and most important Fibonacci retracements. So, in my opinion, 23.6 is very important. Is not very important. 38, 50, and 60 are important. The most important are 78 and 88.6. 23.6 is shallow retracement. 38.2, 50, and 61.8 are standard retracements. 78.6 and 88.6 are deep retracements. So have in mind that for generally, for strong trends, 23.6 will act as an interim support or resistance. But for normal moving market, 23.6 will usually be neglected, and the price might turn down to 38.2, 56, and 61.8. Very often, the price will get to 78.6 and 88.6 and then reject. And traders might think that this is actually that this is the change of the trend. But what happens sometimes, very often, the price will hit 78.6 or 88.6, and then it will spike to the upside. Now, as I said, I will give you and I will teach you how to put additional Fibonacci levels, how to put correct price before the levels, and we'll show you how to plot extension. Next session, I will teach you how to use these special numbers and how to use special numbers with extensions. So now when you plotted your Fibonacci, you need to click properties. When you click properties, sorry guys, objects list here, and then properties. Okay, so objects list, click on Fibo, and then properties. So once more, right click, object list, left click, properties. And here you can change the color, you can change the style. Let's use, for example, this one. And when you go to levels, you will be actually seeing these levels. Default levels are not 78.6 and 88.6. Have in mind that you need to add them manually. Okay, so you need to add manually these levels. They are not shown by default, guys. Have in mind, it's very, very important. Now, if you want to add these levels, okay, you need to double click. First, you need to click add, and then 0.786 and 78.6 in description, 0.886 and 88.6 in description. If you want to add more levels, you need always to click add and then OK. Now, also a lot of traders don't know how to add specific levels. Okay, it's important to know how to add specific levels to Fibs. It's also a trick. You need to add percentage, then a $sign. So if I want to add specific level here, I will type percentage and the $sign. Now, when you click OK, you see 00 level has the exact level 0.74367. So this is the level for 00 retracement on the New Zealand dollar pair. You don't need to do this multiple times. When you do this once, then your MetaTrader 5 will remember your choice. So let's add more. if you go to objects list, then properties, you just need to copy this, okay? And you can use spaces. You can use like 3 spaces like this, okay? And just add as I do it, like this. We can add one more space to make it more visible, like this. So now you see there are fibs, but also just to the right side of fibs, you can see levels. And that level corresponds to any pair, any time frame. It doesn't matter, whatever you want to see, you will see. For example, gold also. So insert objects, Fibonacci retracement, for example, like this. So remember, guys, in downtrend, you also need to draw your Fibonacci retracement from left to right. In downtrend, contrary to uptrend, you start from the top to the bottom. And here are your retracement levels. 2 more good retracement levels that I will show you and that we will be using next session are 9 and 14. So when you go to objects list, and you can use, doesn't matter, whatever fib you use, you just press add 0.09, then you add this, make a little bit space, and here. Also, you can add 14.6, okay. And when you go to Fibonacci, so you see, actually this should be 14.6, so you can easily make a change. So levels and 14.6. So these are very important Fibonacci levels, and I advise you to use them on your charts. Also have in mind that you can also add text here. If you go to objects list and then double click fib, you can also write like fib retracement or whatever you want to write. Okay, so it will actually be printed also on specific Fibonacci retracements. Now, other point of using Fibonacci's are actually to know which are most important swing points. Most important swing points for Fibonacci's are always found on higher time frames. Fortunately enough, the MT5 has higher time frames. I started to use H8 in my trading and analysis, and you will be seeing very often the analysis and trade setups also on 8-hour time frame. In my opinion, 8-hour time frame is very strong. Today, for example, I traded Euro Australian dollar. I still in a trade, and the short was also signaled very, very accurately on 8-hour time frame. So 8 hours is also very important. Now, for that reason, I might say for Fibonacci retracement, you should use, if you're intraday trading, 1-hour time frame or 4-hour time frame. For swing trading, you can use 4-hour time frame and 8-hour time frame. Now, how to draw specific Fibonacci expansion? When you go to insert objects and here Fibonacci expansion, you always need to connect most important swing points. So for this, let's say example, we will use again most important swing points. So for this previous swing, I will do it like this. First, we will remove this one. We will remove everything, and we'll show you directly here how to do it. Okay, let me just remove like this. You can leave your pivot points. You know that my favorite is Camarilla, so I tend to leave it. So if we want to calculate, let's say, this swing from this spot, or let's use this swing from this spot to this one, because when we went short, we used this swing from the high to the low. First of all, you need to go to Insert, Objects, Fibonacci, Expansion. I think it's yellow, so I will need to actually, you see, probably it's yellow color. So I will, you see, I will just remove this and put it to blue, make it dotted. Okay, and here are the levels. You see, now you see the levels. Now you need to connect the swing in order to plot out Fibonacci retracement. The swing is always found whether in the concept of a swing high or a swing low. The swing is always the swing, so you need to mark it before you actually chart your Fibonacci extension. In order to help you to find swing points, you can also use Fibonacci retracements. So if we put a Fibonacci from this point to this point, you see that this actually corresponds to 38.2 fib. Then you just plot your retracement. Okay, so once more, you can first plot your Fibonacci retracement like this. Find the corresponding swing. If this is your entry point, so you need to mark your entry points. If this was your entry point, you go to Insert, Objects, Fibonacci, Expansion. Plot your swing from the same perspective. Wait, this. So from this spot to this spot. And also mark the swing. Your corresponding swing was actually found here. Okay, so here. Let's do it again. I just need to switch colors because colors are now mixed here. So your Fibonacci expansion is, so 0.1, 0.2, and here you need to draw 0.3. Okay, once more, Fibonacci expansion is here. So don't forget that swing points are important here. You need to connect swing points. You cannot plot it randomly. So if this was the main swing point that it really was, and you made your entry here, you need to mark it like this. You cannot mark this swing or some other swing, because obviously this was the most important swing point. Similar, guys, when you go for, let's use uptrend example. For most important swing points, you can use, let's use 8-hour time frame. And let's find an example. I don't know, we can go with euro dollar. Okay, this is a nice example. This swing and this swing. So let's say that we traded euro dollar like this. So first of all, you need to mark your retracement. So we found that most important retracement was actually here. See, straight from 61.8. Straight from 61.8. Then you go with Fibonacci expansion, okay, from this spot to this spot, and you mark swing like this. And you see that basically this expansion marked the targets. So don't forget, Fibonacci retracement marks your swing points and entries. So it's usually used for entries, while Fibonacci expansion marks your targets. And you can also use it in a confluence with other price action tools such as pivot points and let's say important levels of support and resistance. Default Fibonacci expansion levels are 61.8, 161.8. Usually 61.8 is hit The first that it is followed by the 100, but 161.8 is not hit that often if the price is not in a huge uptrend or downtrend. So, as I say, for this session, it's enough to know this for starters. Next session, we will explain, I will personally explain you the most important Fibonacci expansion. We will add few more because these are not all, and how to use 9 and 14 in retracement in counter trend trading. So thank you guys for listening. If you have any questions, feel free to ask. If not, this webinar is being recorded. It will be uploaded, and we will proceed with the part 2 in 2 days. I don't see any questions, so I assume that everything is clear. Thank you guys for listening. Try to use this on MT5, and if anything is not clear, feel free to send us an email. Cheers, everyone, and as always, trade safe.